And joining us now is Meghan Shue, Chief Investment Strategist at Wilmington Trust. There's the futures this morning. We've got a little bit traded off just a little bit, but not too bad. She's also a CNBC contributor. And I don't know, Meghan, you're in a bad place. I just reading your notes. You got a lot of worries, a lot of concerns, don't you? The earnings have been good, you say, but that sets us up for maybe some weakness if there's any disappointment from what are already some lofty levels. And you're not, I think, in consensus on the economy this year. You think you're really seeing cracks in the labor market, which could indicate the economy is not so strong.
Yeah, that's right. I think earnings season so far has been good. I think we've gotten so far pretty much what we need to hear from companies in terms of delivered fourth quarter results. I think the guidance for the current quarter and the full year has been, I think on the margin, slightly disappointing, and it's all relative, right? With valuations as extended as they are, it seems like any companies that are not beating by an extraordinary amount or guiding significantly higher can see their shares fall. So I think that is more a statement of a lot of optimism in the market, rather than any sort of negativity on the actual earnings, because earnings have been solid. But you're right, we are more pessimistic than the street in terms of the economy, with about a 1% GDP forecast for 2026. And that is primarily because of, as you said, cracks in the labor market, specifically private job growth, ex-healthcare being negative. It's very rare to see that outside of a recession, and this time might be different. There's a lot of different forces acting on the labor market right now, but it definitely gives us some caution.
You're not sure what's causing that. Could be AI, could be immigration. You whatever it is, you think it's troubling.
It's all of it. I think it is supply on the supply side. Reduced immigration is for sure reducing the so-called run rate of net new job growth. AI is a factor, probably at the margin and in certain pockets of the labor force, programmers, and certain jobs that are being affected, rather than broad-based job losses at this time. I think a lot of the talk about productivity and AI is probably more companies signaling where they're going rather than what they're actually doing today. There's a reticence to hire for sure. And then probably the lingering impact of tariffs and geopolitical risk and uncertainty. It was just a few weeks ago that we were talking about, possibly more tariffs on Europe. So all of that weighs on confidence, especially for CEOs and consumers, which has not been the best barometer of spending and investment decisions. But, it certainly has played into the muted CapEx figures that we've seen outside of technology.
Your relative, I'm not going to call it bearishness necessarily, but your non-enthusiasm isn't because of worries about inflation. I was going to say at least that's a bright side. You think the Fed gets the 2 and hits the target, so that's good. You could be happy about that, Meghan. I mean, but at the same time, you don't necessarily think that the Fed's going to cut, and that could be a disappointment. Why would the Fed not cut?
Well, I think that's the risk. Our base case actually is that the Fed will be cutting more than what the market expects. And that is, for all of our caution on the economy, we are fully invested right now. And one of the reasons for that is we do think we'll get a little bit more easing from the Fed, hitting that 2% target. We expect 3 rate cuts this year, and inflation is not a primary concern. It's more just the risk that consumers cannot continue to spend at these levels because spending is outpacing income growth. And the only way that continues is if you take on more debt or further spend down your savings. But I think there are a lot of other tailwinds underneath the market that are a little bit different than what's happening in sort of Main Street economy. And we do think you need to be fully invested here in the equity market.
Really? So after all that, so stay invested in the S&P somehow managed to be right at a high, which is, we've seen a lot of them in the last, 10, 12 months. Actually, in the last, a market's at an all-time high. Obviously, we've seen a lot of new highs in recent years. You think for a forecast, you don't probably do that, but what would you expect us to reach this year on the S&P?
Yeah, well, we have solid earnings growth projected out for the next couple of years. About 15% this year, maybe closer to 10% the following year. I don't think you get a lot of lift from valuation expansion at this point, but I think you could see that, the high single-digit returns for the equity market this year, and a lot of that will probably come from continued momentum. There's been a very high cost to sitting out the market and being too bearish, so we're very much aware of that.
I think you should be in a better place, Meghan, after all of that. That's the conclusion we're coming to, but you just want to make sure that you're, paying attention, I guess. You've got fiduciary responsibilities. Thank you.
That's right. Yeah, thank you.
If you're not worried, there's a problem. All right.